1 minute smarter, every market clearer. Welcome to my channel, I'm Claire. Hello everyone, and welcome to today's deep observation. We are currently standing at a very peculiar historical junction. If you look back from the threshold of 2026, you'll find that the U.S. stock market over the past 3 years has felt like an unreal dream. Everyone is making money, but strangely, this prosperity hasn't brought a sense of security. Instead, the air is filled with an unsettling, tense electric charge. Let's take a deep look at the grand backdrop we are currently in. If you were to find the most fitting metaphor for this bull market from 2023 to 2025, I think it's like a rubber band being continuously stretched. Interestingly, the data presents us with a set of staggering numbers. In 2023, the S&P 500 recorded strong growth of 24%, following that in 2024, the market did not weaken as expected, but continued to push higher with a gain of 23%, and in 2025, as of now, we have already seen a gain of about 17%. This rubber band has been stretched for 3 full years. The longer and tighter it is pulled, the more energy it accumulates. It can indeed carry us to higher places, but please do not forget that once it snaps, the destructive force generated in that instant will be devastating. I find it very interesting that in today's market, there exists an extremely contradictory psychological atmosphere. Wall Street's most famous bull, Tom Lee, the founder of Fundstrat, predicts that in 2026 we will see a 4th consecutive year of double-digit growth. Yet, in opposition to this optimism, the thunder of a crash above the market is growing louder. I don't intend to give a simple conclusion on whether the market will go up or down, because such predictions often seem pale and powerless in the face of a volatile market. What we need to do is deconstruct the logic of Wall Street's top minds and see clearly the structural cracks hidden behind the prosperity. Let's first talk about Tom Lee. He has been one of the most accurate prophets on Wall Street over the past few years. When everyone was panicking about a recession in early 2023, he remained steadfastly bullish. When the market fluctuated violently in 2024, he told you to have faith. Interestingly, the data shows that Tom Lee's core view for 2026 is very direct. This will be another year of double-digit growth. If this prediction comes true, it means we will welcome an extremely rare 4-year streak of massive gains. The first solid pillar supporting his bold script is the so-called miracle of historical probability. He leafed through the long scrolls of history over the past 100 years and found that the market has seen 12 instances of 3 consecutive years, with gains exceeding 20% in a century. In most people's intuition, after rising for 3 years, the 4th year must fall. However, the data provides a counterintuitive conclusion. In these 12 instances, there was actually a 50% probability that the 4th year performed even better than the 3rd. Wait a minute, let's look at this logic again. The financial market is not a simple game of mean reversion. It possesses immense momentum inertia. When this inertia is completely ignited by the current AI technological revolution and the liquidity released by the Federal Reserve, the upward thrust it generates often surges toward a high point that most people wouldn't even dare to imagine. I find the discussion about the valuation trap to be quite fascinating. Many people say the current stock market is too expensive, and the price-to-earnings, PE ratio of the S&P 500 looks unattainable. Currently, the PE ratio of the S&P 500 is around 28 times. Historically, this has indeed entered the red warning zone. But Tom Lee offers a very profound perspective. We need to look at the S&P 500 equal weight index. Usually, the index we see is market cap weighted, with weight concentrated on tech giants like Nvidia and Apple, naturally making it look expensive. But if you spread the 500 companies equally, you will find that the PE ratio of the equal weight index is only 17 times. What does 17 times mean? It is even lower than it was 5 years ago. This shows that during the pandemic lockdowns, soaring inflation, and interest rate hikes of the past few years, most ordinary companies did not experience a bubble. Instead, they underwent a long period of valuation compression. If the Federal Reserve continues its rate cut cycle in 2026, these suppressed ordinary companies might see a magnificent catch-up rally. Let's take a close look at the 3 layers of background Tom Lee has painted for 2026. The first layer is strong GDP resilience. Although recession fears have never disappeared, economic fundamentals remain solid. The second layer is a dovish Fed. The rate cut cycle has begun, and money is becoming cheaper. And the third layer, which is the most wondrous, is exceptionally pessimistic sentiment. This is a classic contrarian indicator. When the market is performing so well but everyone is still doubting and fearing, this wall of worry instead becomes the fuel that pushes stock prices higher. In his script, although the first half of 2026 will see violent volatility due to panic over tariff policies and the uncertainty of the Fed's leadership transition, as long as we make it through the second half of the year, will be a festival of wealth. And the S&P 500 might even charge toward 500 points. However, as a rational observer, I must pour some cold water on this optimism, because the risks in 2026 will also be several times the sum of the past 3 years. When a bull market enters its 4th year, the nature of the market has changed. We must deeply explore 4 potentially fatal hidden risk points. The first is the double-edged sword of the unemployment rate. Currently, the unemployment rate remains around 4.5%, which is considered a golden balance point. It neither triggers wage inflation nor causes a consumption collapse. But remember, the deterioration of the unemployment rate is never linear. It is explosive. The current 4.5% is already showing some slight pain. If companies begin large-scale layoffs in 2026 due to AI efficiency gains, or if small and medium-sized enterprises collapse due to the lag effect of high interest rates, once the unemployment rate breaks through 6% and accelerates, the bull market will instantly turn into a horror movie. Interestingly, physics has gravity, and finance also has the pull of mean reversion. The market has significantly deviated from historical average returns for 3 consecutive years. It's like a person jumping into the air on a spring. The longer he stays in the air, the more gravity accumulates to pull him back to the ground. Statistical laws may fail in a certain year, but they will never disappear forever. The next third risk is a structural threat that many retail investors don't understand, but is extremely dangerous: the ghost of the yen carry trade. For a long time, global investors have borrowed yen at near-zero interest rates to buy high-yield U.S. tech stocks. This has been seen as an infinite money glitch. But if the Bank of Japan is forced to raise interest rates significantly in 2026 to fight inflation while the U.S. is cutting rates, the narrowing interest rate spread will cause massive amounts of capital to flow frantically back to Japan. At that time, to repay yen debts, investors must sell U.S. stocks regardless of the cost. We already saw a small-scale rehearsal of this power in August 2024. If a full-scale retreat occurs in 2026, the consequences will be unimaginable. I find this point is very fascinating, and that is the 1970s inflation shadow that I worry about most. If the Fed cuts rates too quickly for votes or under pressure, while imported goods become more expensive due to tariff policies, inflation is very likely to repeat the Twin Peaks pattern of the 1970s. Once inflation rebounds, the Fed will have to aggressively raise interest rates again. This policy U-turn would be devastating to the market because it would completely destroy investor expectations. To understand 2026, we must also understand the cyclical behavior of the market. A classic bull market cycle usually goes through 4 stages: hope, conviction, euphoria, and finally, correction or collapse. I believe that in 2026, we will officially enter the transition phase from conviction to euphoria. The characteristic of the euphoria phase is crazy, irrational wealth effects. Neighbors start recommending stock tickers to you, and social media is full of myths about getting rich overnight. While this doesn't mean a crash will happen tomorrow, it means your margin for error has become very low. In this stage, the most common mistake retail investors make is using leverage due to FOMO, fear of missing out. This is like tying all your family's assets to the rubber band when it is stretched to its absolute limit. So, facing a year like 2026 where opportunities and risks coexist, what should we do? The principle I have always advocated is be prepared, not predictive. People who predict market tops usually get slapped in the face, but those who prepare for various possibilities are the ones who can walk away from a cycle unscathed. I have summarized a 6-step tactical framework for you. Step 1. Clear all leverage. If you are still using margin trading or borrowing money to buy stocks, please find an opportunity in the first half of 2026 to unload that leverage. Leverage is an accelerator in a bull market, but it is a guillotine in a bear market. Volatility in 2026 will be very high. A 1% flash crash could cause leveraged players to be liquidated. What we seek is anti-fragility, not licking blood from the edge of a knife. Step 2. Maintain a long-term mindset and stick to DCA dollar cost averaging. No matter how the market fluctuates, your core investment portfolio, such as an S&P 500 ETF, is the foundation of your portfolio and should not be sold in panic. I found that data shows giving up long-term compounding is the stupidest thing in the world. Over the past 20 years, if you miss the top 10 best-performing trading days, your total return would be reduced by a full 50%. If you exit during a pullback in 2026 due to panic, you may never recover that lost wealth. Step 3. Increase the diversification and defensiveness of your portfolio. In addition to the S&P 500, you should start paying attention to some forgotten corners, such as S&P 400 mid-cap stocks, whose valuations are currently very reasonable. At the same time, pay attention to defensive sectors like telecommunications, healthcare, and consumer staples. When high-valuation tech stocks adjust, these boring industries often become safe havens for capital. Steps 4 and 5. Allocate to low-correlation assets and build cash reserves. Set aside funds for gold or short-term treasury bonds. This isn't to get rich, but to ensure that when a black swan arrives, your wealth system doesn't collapse instantly. Holding cash serves two purposes. First, if there is a big drop, you don't need to sell at the bottom for living expenses. Second, when everyone is selling in panic, ensure you have the money to buy excellent assets at the bottom. Great investors like Warren Buffett are wealthy because they have the cash to buy quality assets during a crash. Step 6. Appropriately lock in profits. If certain stocks have already made you 3 or 5 times your money, please appropriately trim your positions during the extreme market euphoria of 2026. This could be 10% or 20%. This isn't called liquidating, it's called taking profits. You still retain 80% of your position to enjoy potential further gains, but that 20% profit is the insurance you buy for yourself. Remember, when the bull market ends, people aren't compared by who made money the fastest, but by who could take the money home. Why do ordinary retail investors always lose money? Because their behavioral time horizon is misaligned. In a bull market, a retail investor's vision expands to infinity, feeling that wealth growth will last forever. But in a bear market, their vision shrinks to a single day, and they feel like the world is ending if it drops for just one day. Successful investors must do the opposite of the crowd. When the market continues to climb in 2026 and your friends are all talking about how much money they've made, you should feel an instinctive alertness and start thinking about protection and risk. We must understand that an investor's task is not to predict the future, but to manage risk. If 2026 truly sees the S&P 500 surge to 8,500 points, as Tom Lee says, then our remaining 80% position will still allow us to make a fortune. But if 2026, unfortunately, becomes the year the bubble bursts, because we cleared leverage-reserved cash and allocated defensively in advance, we will not only survive, but also be able to pick up those life-changing quality chips when others are in despair. We are at a turning point of an era. AI is reshaping productivity, the Fed is adjusting the valves of global liquidity, and the greed and fear in human nature remain unchanged, just as they were centuries ago. The stock market of 2026 is both a playground for the brave and a graveyard for the reckless. May you be a captain who remains sober in prosperity, rather than a follower who loses their way in the madness.